Hey everyone, welcome to my channel. Today we're diving into the gold market and why prices could climb even higher in 2025. Gold has already had an incredible run, but many experts believe this rally is far from over. I've researched the latest data and expert opinions to bring you the complete picture of what's driving this gold rush. Let's break it down. Gold is currently trading around $3,317 per ounce, after averaging $2,860 across the first quarter of 2025. This represents an astonishing 28% increase just since the end of 2024. The first quarter of 2025 saw gold demand reach a 9-year high of 1,206 tons, continuing the momentum from record demand in 2024. What's fascinating is that this price surge isn't just speculative, it's backed by fundamental demand across multiple sectors. Total gold demand rose 1% year-over-year to 1,206 tons in Q1 2025, establishing a solid foundation for the metal's record price performance. This broad-based demand creates a powerful upward force on prices that could continue throughout the year. The first major factor driving gold higher is economic uncertainty. Gold has always been the go-to asset during uncertain times, and current market conditions are playing right into gold's strengths. With growing concerns about the U.S. economy and the escalating trade tensions between the U.S. and China, gold has become increasingly attractive as a recession hedge solution. Gold typically shines brightest when other assets are struggling. It's like financial insurance that actually goes up in value when trouble hits. As one analyst put it, gold becomes the most sought-after asset class during uncertain and global risk periods, which is exactly what we're experiencing now. This flight to safety is a powerful price driver that shows no signs of abating. Central banks worldwide have embarked on a historic gold buying spree, providing crucial support for higher prices. Since the freezing of Russian central bank assets in 2022 following Russia's invasion of Ukraine, central banks globally have been dramatically increasing their gold reserves. Poland led central bank purchases in Q1 2025, adding 49 tons to its reserves as part of a strategic diversification program. Other significant buyers include various Eastern European nations seeking financial stability outside the Eurozone framework. Goldman Sachs recently raised their gold price forecast partly because central bank demand has exceeded expectations. If central banks continue buying at around 70 tons per month, that alone could push gold to $3,200 by year-end, according to their analysis. It's not just central banks. Regular investors are piling into gold as well, creating another powerful upward force on prices. Investment demand for gold increased by an impressive 170% year-over-year to 552 tons in Q1 2025, reaching the highest level in 3 years. ETF inflows led this charge at 226 tons during the quarter, a dramatic reversal from the outflows seen in previous periods. Even retail investors are getting in on the action. Bar and coin demand has remained elevated at 325 tons, 15% above the 5-year quarterly average. This demonstrates gold's broadening appeal beyond institutional investors, creating a more diverse demand base that supports price stability and growth. Interest rates play a crucial role in gold prices, and the current environment strongly favors higher gold prices. Gold doesn't pay interest or dividends, which means it traditionally performs better when interest rates are low. With the Federal Reserve expected to cut rates in 2025, gold becomes more attractive compared to interest-bearing assets like bonds. Recent research confirms that real yield, measured as the TIPS rate, has the largest impact on gold price, followed by the inflation rate. As one study concluded, it is reasonable that the real yield is the main driver of the gold price, because the higher the real yield, the less attractive it becomes for investors to own gold, as it is not an interest-bearing asset. With real rates expected to decline, this creates a powerful tailwind for gold prices. Persistent inflation concerns continue to benefit gold prices. Historically, gold has performed well during periods of high inflation, and current market conditions appear to be reinforcing this pattern. Additionally, questions about traditional safe havens like U.S. Treasuries are redirecting substantial investment flows toward gold. Higher selling in U.S. Treasuries can push gold prices higher as investors seek alternatives. As one analyst noted, when bonds are offloaded, the 10-year yield rises, sending a signal that even the U.S. Treasury is no longer a safe place to park funds. In such a scenario, gold finds new buyers and the price shoots up. Gold offers zero counterparty risk, making it increasingly attractive when confidence in conventional financial assets wavers. This fundamental advantage becomes increasingly valuable in uncertain economic times. The world isn't getting any less complicated, and geopolitical tensions continue to drive gold demand higher. Political tensions and trade concerns, including potential U.S. tariffs on imports, have driven many investors toward gold as a store of value. The prospect of escalating trade disputes has created market anxiety that typically benefits traditional safe haven assets like gold. These concerns have pushed speculative positions in gold to very high levels. While Goldman Sachs notes this could lead to some profit-taking, continued uncertainty about tariffs, geopolitical risks, or government borrowing could push speculators to increase their long positions in gold further. So where do experts see gold prices heading? The forecasts are notably bullish. Goldman Sachs. Research has raised its gold price forecast to $3,100 per troy ounce by the end of 2025, up from their previous projection of $2,890. They even suggest that under certain conditions, prices could reach $3,300 by December 2025. JP Morgan's outlook remains bullish as well, with expectations for gold to move toward $3,000 per ounce this year. Some analysts are even more optimistic, suggesting gold could approach $3,400 or higher, especially if economic and geopolitical uncertainties persist. When you put all these factors together, central bank buying, strong investment demand, expected rate cuts, inflation concerns, geopolitical tensions, and questions about traditional safe havens, the case for higher gold prices becomes compelling. While nothing in markets is guaranteed and we might see occasional profit booking in the short term, the fundamental drivers supporting gold appear strong for 2025. That's my analysis of why gold prices could continue rising this year. If you found this breakdown helpful, please hit that like button and subscribe for more financial insights. Drop your thoughts in the comments below. Are you investing in gold this year? Why or why not? Thanks for watching, and I'll see you in the next video.